Hello, managerial accounting students. This is the last chapter of your journey with me here in managerial accounting. We're going to just talk about briefly some of the things for performance and evaluation and something we call balanced scorecards, where we can take a look at how management is doing. This is just informational. There'll be no formal homework on this. However, you will be responsible to be able to answer some questions as far as the final goes. So let's just go ahead and take this journey together, and we'll walk through the slide. So Chapter 11 addresses the challenge for companies in finding tools that allow for the evaluation of managers at all levels in the organization, from a plant manager in a factory to the manager of a retail store, to the regional sales manager, to the CEO. One way to do this and react more quickly to changing market conditions is through what we call a decentralized structure. Management of decentralized organizations vary from organization to organization. Most organizations are decentralized to some degree. At one end of the spectrum, managers are given complete authority to make decisions at their level of operations. At the other extreme, managers have little, if any, authority to make decisions. Most firms fall somewhere in the middle. What I find fascinating about this particular slide is about 10 years ago, when HP acquired Compaq, one of the very difficult tasks of joining those two very large companies was bringing together their two forms of management. HP was actually, we had great decentralization. Managers were given autonomy to make decisions, and in fact, the managers sat among all their employees to get better feedback. And we used to do what we called management by walking around, where Compaq, all the managers were in offices with closed doors, and their managers always had to check with the next manager or the next manager before they could make any decisions. And it was really funny when we brought the two together. It was like, whoa, can't you Compaq people make any decisions? And it was a very different system there, and to join the two corporations was very challenging at first. Benefits to decentralization are that decentralization fosters an environment of entrepreneurship and innovation. And if you think about HP, our logo even said HP invents on it. And so when you are decentralized, you have this feeling that you're in your own company and you can be very innovative. Generally, those closest to a problem are most familiar with the problem and its root causes. By pushing decision-making authority down to lower levels, managers most familiar with a problem have the opportunity to solve it. Top management has more time to devote to long-range strategic planning, as decentralization removes the responsibility for much of the day-to-day decision-making. Studies have shown that managers allowed to make decisions in a decentralized environment typically have higher job satisfaction than managers do in centralized organization. Also, managers who are given increased responsibility for decision-making early on in their careers generally become better managers because of the on-the-job training they receive. In other words, experience is the best teacher. Decisions are often made also in a more timely manner. So there are at least 6 benefits to decentralization. Obviously, to the benefits, there's also drawbacks. These drawbacks include when decision-making authority is spread among too many managers, a lack of company focus can occur. Managers may become so concerned with their own areas of responsibility that they lose sight of the big picture. Because of the lack of focus on the company as a whole, Managers may tend to make decisions benefiting their own segments, which may not be in the best interest of their company. Sometimes we also call those segments silos, and sometimes you can be so silo-focused you don't know how you all blend together. Managers may also not be adequately trained in decision-making early in their careers, and the cost of training managers can be high. The potential costs of bad decisions while new managers are being trained should always be considered. They may also lack the coordination and communication between the segments. This decentralization may make it difficult to share unique and innovative ideas. And decentralization may result in duplicate efforts and duplicative costs. So the drawbacks to decentralization really, I don't think, outweigh the benefits of decentralization. So now we're moving on to responsibility accounting and what we call segment reporting. The key to effective decision-making in decentralization organizations is responsibility accounting. In other words, holding managers responsible for only those things under their control. In reality, the amount of control a manager has can vary greatly from situation to situation. So it's really important that we only hold managers responsible for the things that they have control of. Organizations typically identify different segments or levels of responsibility as cost, revenue, profit, or what we call investment centers, and attach different levels of responsibility to each segment. So the centers that we're looking at here is we have a cost center responsible for costs only. So they're only responsible for direct labor, for direct material, for overhead, etc. Revenue centers mean that they're only responsible for generating the revenue. Profit centers responsible for costs and revenue. And then we have investment centers where they're responsible for profit, investments, and property, plant, and equipment. HP is structured more where we have profit centers, and then we have a whole segment that has to do with real estate and fixed assets. So HP is typically, we have different profit centers. For instance, we have our PC division. We have our printing division. We have our server division. We have software. We have our financing division. And so most of the time, HP, and very likely you will see many companies focused with the profit approach. So let's go ahead and take a look at each of these different centers. A cost center manager has control over costs but not revenue, or capital investment long-term purchasing decisions. Performance reports for cost centers typically focus on differences between budgeted and actual costs using variance analysis, which we will have covered or will cover in chapters 9 and 10. The purchasing manager of a store, the production manager for a particular type of DVD player, the maintenance manager in a hotel, and the human resources manager of a CPA firm would likely be considered managers of cost centers. The manager of a cost center should be evaluated on how well he or she controls cost in their perspective segments. Now, I disagree. I can agree a little bit with the human resources because they hire the CPAs and then the CPAs bill out the revenue. But so perhaps that one is a little convoluted, but I'll go ahead and agree what I've just talked myself into agreeing with why they're coming up with just the person who's doing the hiring. When we move on to the revenue center manager has control over the generation of revenue but not costs. Performance reports of revenue center often focus on sales price variances. And some examples we might take a look at is the sales manager of a retail store, the sales department of a production facility, and the reservation department of an airline. So they all are about generating revenue, not really controlling the costs of their particular department. Next, when we move to more of a profit center, the profit center manager has control over both cost and revenue, but not the capital investment decisions, like we don't decide if we're going to buy a building or if we need equipment and so forth. Performance reports typically focus on the income measures such as the overall flexible budget variance, segment margins, and so forth. While the purchasing manager of a retail store is a cost center manager, the overall manager of the store will probably be interested in, it would be a profit center manager. Likewise, the manager of an entire product line in a factory, the manager of a particular location of a hotel chain, and that partner in charge of the tax department at the CPA firm, those would all be considered profit center managers. The last of those centers were the investment center, is typically a separate business with its own value chain, commonly referred to as a strategic business unit or SBUs. So HP has strategic business units. We also have GBU, which are global business units. Investment center managers can be evaluated similar to profit centers, but tools are adjusted for the amount of assets or investment they also control. Examples of an investment center manager include the core division manager of an international company or a corporate headquarters in charge of large decentralized organizations. Profit center performance and segmented income statements calculate income for each major segment of an organization in addition to the company as a whole. Variable costs are traced directly to a segment since they vary in direct proportional sales volume, and we can allocate it based on a segment. Fixed costs that can be easily and conveniently traced to a segment should be assigned to that segment. Common costs benefiting multiple segments are not allocated for performance evaluation purposes. So what we're talking here is being able to take a look at each of your segmented income statements and so forth. So for HP, which is what I'm going to draw on in this example because I live and breathe this, is our PC division has its own segmented income statement. Our printing division, our server division, our software division, all have their separate segmented income statement. So what's a good test for deciding whether to allocate indirect fixed cost to determine whether the cost would be reduced or eliminated if a segment was eliminated? If the cost cannot be reduced or eliminated, it's what we call a common cost. So how do we apply common costs in practice? Sometimes companies allocate common costs from headquarters to segments without using them for evaluation purposes. This practice has the advantage of making the segment manager aware that the cost is being incurred and that the cost must ultimately be paid for by revenue generated by that segment. If other indirect costs are to be allocated to the segments, there should be sufficient causal relationships between the costs and the segments. Arbitrary allocations may lead to less than optimal decisions about a segment. So it's really going to be based on the knowledge that you have of your business, determining if it's applicable to allocate that fixed cost or not. Let's go ahead now and take a look at a sample of a segmented income statement. So what you're going to see down is you see this slide broken down into 3 segments based on the 3 practice departments in a CPA firm. You have over here the total, you then have the tax department, the audit department, and the consulting department. Notice that the bottom segmented income statement is actually a drill down presentation of the 2 divisions within the tax department. So for both statements, the contribution margin format is used, with added features of separating out fixed cost into traceable fixed costs and common fixed costs, then showing the interim calculation of the segment margin. So what they've done is they've kind of taken that down and then they've broken it down to take a look at the contribution margin. So you can see here, how everybody is, actually contributing, and then when you take out the common costs, what we end up with the net income. So it's a really good way to kind of take a look at how each business is doing to determine if, in fact, we do want to keep those particular segments. Continue to look at that statement, and here we look at a modified contribution margin formatted in this particular income statement, and I find it to be very advantageous in this approach because first, the contribution margin and the contribution ratio, are primarily measures of short-run profitability, as they ignore any fixed costs. Segment margin and segment margin ratio are a measure of long-term profitability and are more appropriate in addressing long-term decisions, such as whether to drop product lines, such as whether, and so forth. The way that we get that segment margin is we take the segment margin calculation and we divide that by sales, very similar to what we did for the contribution margin. And so this is good for looking at long-term, where the contribution margin is good looking at the short-term profit. Let's go ahead now and take a look at what happens with the investment centers. So investment center managers can make capital purchasing decisions, including decisions like expanding facilities. Investment centers are typically major divisions of a company involved in all aspects of what we call our value chain. Evaluating investment centers requires focusing on the level of investment needed to generate a segment's profit. Performance reports focus on a return on investment and what we call residual income, which we will talk about at the end of this chapter. So we have return on investment, which we call ROI, and then sometimes you will see the line item residual income. So what is return on investment? Return on investment, or as I had mentioned, which is called ROI, measures the rate of return generated by an investment center's assets. So it's the rate of return generated by an investment center's assets. The calculation of ROI is generally broken down into two components: a measure of operating performance, which we call margin, and a measure of how effectively assets are used during a period. We call that asset turnover. So what does that mean? Return on investment formulas look like this. So ROI equals margin times turnover. So the way that you determine margin, you take net operating income divided by sales. Net operating income divided by sales. And I do want to tell you, you will be accountable for this formula, for being able to determine return on assets. So the ROI is margin. The way that we compute margin is we take net operating income divided by sales. The way that we get the turnover part is we take sales divided by average operating assets. So when we look at it and we cross out sales in this particular formula, we get net operating income divided by average operating assets. So that's how we determine our ROI or our in this particular slide. And perhaps at the end I will have a opportunity to do an example of that in another segment. So let's go ahead and take a look at return on investments, the numerator. So we're going to take a look at what that was, and that was net operating income. Is a measure of operating performance and is defined as income before interest and taxes. Before interest and taxes. Interest and taxes are typically omitted from the measure of income in the ROI calculation because they may not be controllable by the manager of the segment if that's what we're being looked at. So that's how we get that ROI numerator. Go ahead and take a look at the denominator now. And the most common measure of investment is average operating assets. That's an average of beginning and end of the period numbers. Operating assets typically include cash, accounts receivable, inventory, and the property, plant, and equipment needed to operate a business. That is what we call average operating assets. So effectively you take the beginning balances of all of those plus the ending balances divided by 2 to get our denominator. What is, and we'll do an example of that in an additional exercise. So what is residual income? Residual income, or an alternative to evaluating the manager of an investment center on the basis of ROI, is residual income generated by that investment center. Residual income is the amount of income earned in excess of a predetermined minimum rate of return on assets. All other things being equal, the higher the residual income in investment center, the better. Residual income is calculated as net operating income minus the product of average operating assets times the minimum required rate of return. So down here you see net operating income minus the average operating assets, which you got from the ROI calculation, times a minimum required rate of return. So, and you're not going to be held accountable for that formula, but I want you to understand what it is that it means. ROI versus residual income. In some cases, using ROI to evaluate the performance of an investment center and its manager can cause problems. If the current ROI at a facility is 25% and a manager is evaluated on the basis of the location's ROI, he may reject potential projects or investment that would be profitable but lower the location's overall ROI. So using residual income may avoid this problem. So it will all depend on how your company decides to measure segment leaders. Obviously, there's always pros and cons to each. And so the problem that we see with residual income as an absolute measure, it should not be used to compare the performance of investment centers of different sizes because we can't commonality or we can't common size it. Residual income is more useful as a performance measure for a single center. Since ROI is independent of size, it is better suited and it is used most often in any of our calculations, and that's why I'm going to hold you accountable for ROI. Wow, I'm running out of steam here. I'm going to take a sip of some iced tea. You guys may want to pause it, get up and walk around as we finish going through this Chapter 11. Responsibility centers located in more than one country. So HP has a lot of those. We have a location in Bristol, England. We have one in Grenoble, France. We are in Germany. We are in Asia as well. We are in Latin America, where we can be. We are in Mexico, Argentina, Brazil. And they, being a multinational company, we face a lot of differences, and there's a lot of factors that go into running different regions. So first of all, we have always economic factors, like the stability of the economy, the local currency strength, and inflation. So very different organization if we were in Germany than if we were in Greece at this particular time. And so we are always having to take a look at what makes sense when we operate in various countries. You always have legal and political factors, like the degree of government control and regulation of business and the political stability of each country. We run into that all the time in different countries. So like France, when you lay off a person, they have 1 year that they still get paid and have opportunity to be placed in other places. In the U.S., they have 6 weeks. If that's our company program. In any other company program, you have no time at all. So working with the labor laws in these different countries is very cumbersome. We also can have educational factors like a trained workforce versus a not trained workforce. A lot of our service centers now are in countries like India, Mexico, as well as Costa Rica. Costa Rica, 95% of their population has graduated from high school or have gone on to university. In India, they all speak English very well and have also have a very strong academic programs. So companies look for that as they enter these countries and look for people to be able to do work, quality work at a lesser price than our American workforce. As always, you also have cultural factors like the attitude towards authority, work ethic, commitment to employers by employees, and to employees by employers. And so the cultural factors are very different from the U.S. in different countries, and we have to be able to be resilient to that. We also have something what we call the balanced scorecard approach to performance. That's a measurement that uses a set of financial and non-financial measures that relate to the overall strategy of the organization. We do that by integrating financial and non-financial performance measures. The balanced scorecard helps to keep management focused on all of the company's critical success factors, not just its financial ones. The benefit of the balanced scorecard approach is that short-term operating results stay in line with the long-term strategic focus. So what happens is you want a balanced scorecard, and you could have 4 quadrants where you look at, current, future, issues, financial. So you can kind of draw up that scorecard any way that you want. But you always want to look at not only financial but non-financial measures, like how are we doing in the marketplace? How did that launch of that product go? And so forth. So when we look at the balanced scorecard, hold on, let me change slides here. This is a pretty good slide to kind of take a look at what we look at in this approach. The financial perspective focuses on measures of profit with financial performance seen in the larger context of the company's overall goals and objectives relating to customers, suppliers, internal processes, and employees. The customer perspective focuses on customers and new market as a way to meet or exceed consumer needs in the long run. The internal business process perspective deals with objectives across the company's entire value chain, from research and development to post-scale customer service. The learning and growth perspective links the critical success factors in the other perspectives and ensures an environment that supports and allows the objectives of the other three perspectives to be achieved. The ultimate goal of the balanced scorecard is to use a set of financial and non-financial performance measures that relate to the overall strategy over the organization, taking into perspective the customer, strategy, internal, and how we can grow, how we can improve, learn, and grow. And all of this is, how do we create value for our stakeholders? Measuring and controlling quality costs. Companies have focused on improving the quality of products or services they sell through a variety of initiatives, such as something we call Six Sigma, which I am certified in. Bet you guys didn't know that. The Baldrige Natural Quality Program, the ISO, Family of Quality Improved Standards. For all of these, the focus is to meet or exceed the customer expectations, to have continuous improvement and empowerment of your particular employees. So Six Sigma, you actually can be a black belt of Six Sigma, and it takes a look at the different processes that you can have in your supply chain to be effective, to be able to get the product timely to the customer, and to be able to keep your cost as well. When we take a look at improving the quality of products and services, it is also an important component of both the customer perspective and the internal business perspective of the balance card. From a customer perspective, one of the most important measures of quality is customer satisfaction and the number of customer complaints. From the internal business perspective, quality measures include improving output yields, reducing defects in raw materials and finished products, and reducing downtime owing to quality problems. So we look at it from a customer's perspective. Is our customer satisfied? I can tell you last Sunday night, I flew back from Colorado, and Frontier Airlines will never get another one of my airline dollars. Their customer service was so horrendous, and what they put us through, I will never go back to them. So it's very, very important. Not only that, from the internal business perspective, what's our quality? How can we improve our yields? The more you can produce, the less defects you have, the more money we can make. All of these are important in that balanced scorecard. Remember, looking for balance. There's always a cost of quality. Quality does not come without a cost. To facilitate the comparison of high-quality products with the costs that result from poor quality, quality costs are typically classified into four general categories. We have prevention costs, appraisal costs, internal failure, and external failure costs. We look at these. We have design and engineering, quality training, supervision, improvement, training, and technical. Inspecting the materials, testing the product, final product testing. A lot of times HP products fail here, and sometimes they have to go back to the drawing board. We can have scrap, spoilage, downtime, re-inspections, how we dispose of the defective products. External is, how many repairs are we making under warranty? Do we have to replace defective parts? Do we have a recall? You see that a lot in the automobile industry. Liability costs from that. Any lost sales because people have heard about it. So there is a cost of how we do quality. Obviously, we want to minimize quality costs, and so while maintaining high quality product or service. The goal, of course, is to minimize the quality costs, The traditional view of quality costs is that total quality costs are minimized at some expected level of defects. So where that point intersects is where that, in fact, has been minimized. We can also look at a more contemporary view, which recognizes that a number of failure costs are difficult to measure. For example, poor quality can lead to lost sales. This outcome tends to increase the cost of external failures as a percentage of defective. The contemporary view is the total quality costs are minimized, but what we call a zero defect level. And again, I just want you to know about this. Not going to really be responsible to this particular segment. Understanding that there are costs to quality is what I'd like to hold you accountable for. Well, in the news, there is a lot about performance and management compensation decisions. The choice of the specific incentive structure is very important for goal congruence between the individual manager, the company, and its owners. It makes good tax sense since compensation based on performance-related measures provide an unlimited amount that can be deducted. However, there is a lot of flack right now about what they are calling excessive compensation among the managers. It's what we call very much, I think, in the corporate world, there is excess in compensation. Obviously, like Jerry Maguire said, show me the money. Cash compensation can be paid in the form of salary or end of the period bonuses. HP structure is a paid for performance where we get a salary, and then if we meet our goals, there is a bonus program that happens at the end of the year. Many companies use a combination of the two, which is exactly what HP has done, where we have a base salary and then we have the pay for performance. One of the reasons that they do that is that they're not tied to paying you the extra money unless you deliver. Bonuses tied to a single performance measure are problematic and always lead to manager manipulation. So you need to be careful when you tie it to a single performance measure. Often companies will also offer stock options. In fact, HP has that for many of their high-level execs. In fact, Ann Livermore, which is one of the directors and vice presidents in HP, cashed in $20 million last year of stock options. So they can be very lucrative for the CEOs and directors of corporations. We also have non-cash benefits that can include club memberships, company cars, corner office, and so on. Benefits and perks such as these can be used to motivate managers to attain goals for the organization. And my friends, that is the end. The end. You guys have been one of the most awesome classes and group of individuals I have taught here at this university, and it has been my pleasure to have been your instructor now for the last year. I will miss you all horribly.